Good morning.
Good
It
morning,
is
I'm Jenny
Wednesday,
Rae
May.
LaRue. Hey, Namaan, go ahead.
Hey, January. Well, we're both saying good morning to folks, so they're getting double the good morning today. It's Wednesday, May 7th. We're about 15 minutes before the markets open. My name is Namaan, and I'm joined by my colleague Jenny Ray. Jenny Ray, you want to say hey to the folks as well?
Yeah, good morning, everyone. We're pretty excited about what's happening today. It's like Woodstock for anybody who's thinking about economy and markets with the Fed decision happening today. Markets have largely paused their movements as they're waiting for this decision, but we could see movement if the decision, especially, is not what we expect. We've got talks between the U.S. and China finally actually scheduled even as of kind of midday yesterday. Basically, there was interest, but interest had not materialized for over a month, and so that's pretty big news as well. And then I think we've got some other just interesting stuff on import data, on trade deficits that we're going to kind of unpack today. So, Naman, I know that you're on the road and traveling. Why don't you go first just to talk a little bit about who delivers the news and who's in the chair and why it matters to markets, why they're paying attention to these kinds of things.
Yeah. The markets care not just about the message, but about the messenger. And so one of the interesting tidbits that I've heard, and this first came from Josh Brown at Ritholtz Wealth Management, and he actually might be even citing somebody else's research. But what I've read and heard is that on the days where certain people inside of the administration, more of the trade hawks, the tariff hawks, when those folks are more out front and center in the news, markets are down. And when you have more of the doves who are out front and center in the news, people like Scott Bessent, the Treasury Secretary, markets are generally up. And I don't know if we have enough of a sample size yet to call this causation, but it's definitely interesting correlation that depending on who's speaking for the administration on a particular day, markets respond. And I would argue that the Trump administration's actually been fairly consistent with its messaging, at least compared to the first term. So, are there variances in messaging? Of course, there are. But I think more than that, there's actually variances in tone and variances in emphasis. And you see those when you have different spokespeople who are representing the administration on the economic front. And so it's just really interesting to me as I look at the landscape that it's not just what the administration is doing that moves markets. It's not even the message that moves markets, but it's the messenger that moves markets. And this is something that we talk a lot about with our clients. One of the things, January, that you know we do quite a bit of, and that I do quite a bit of, is executive communication training for leaders. And one of the things we talk about often is how the content really only drives 24% of your perceived credibility. It's the structure, it's the tone, it's everything else outside of the content that drives 76% of your perceived credibility. And so I think there are people in the administration that get that. And they're emphasizing certain things, they're using a certain tone, and the markets are responding really favorably when Scott Bessent is out front and center, and they're responding less favorably when some other folks are out front and center delivering what's really a very similar message. I'll let you react to
So
that or go ahead.
well, I just think it's important to tie this into the news of what has happened in the last couple of hours. There's been announcements that this weekend in Europe there will be talks between senior level officials. It's pretty notable that it's not presidential, right? It's not the most senior levels, and who is sent is a message to the markets. And so, can you talk a little bit about? I know you've got a little bit of policy history in you there, Naman. But can you talk a little bit about not just the fact that the messenger to our public markets, but also how the messenger on the world stage was potentially chosen and what message it's meant to send in those talks with China this weekend, and why the markets are probably responding the way they are?
Yeah, I think there's two big things that I take away. Number one, it means that the U.S. is serious about actually striking a deal. I think if you send someone like Scott Bessent, you are sending someone who is going to negotiate in good faith to the best of his ability. You're sending someone who has a deep understanding not just of the economy but of markets. And we've talked ad nauseum over the last week about how those are different. But he comes from a hedge fund background, and so he understands the interplay between the real world economy and how markets are going to respond. And for better or worse, that's something that this administration cares about. He also really deeply understands, the importance of foreign capital inflows into the U.S. And I'll break this down in more detail on a future episode, but just to give people like high level insight right now, 18 to 20% of our stock market is made up of foreign capital, or 18 to 20% of the value of our stock market is foreign capital. And then about a third of our treasuries or a third of our debt is held by foreign investors. And so a lot of people hear that and they say, well, that's not good. I would actually argue the opposite. I would say that's very good, because what it does is it shows us that the rest of the world still has faith in America, and the rest of the world would still rather put its money to work here than even sometimes in their own countries or other places around the world. And so that gives us incredible leverage. When you have outsized demand for your treasuries, outsized demand for your debt, what are you able to do? You're able to drive yields lower. It means you pay less interest on the debt. And so one of the things that I'm paying attention to, bigger picture, as you think about the trade war, tariffs, and everything else, is foreign capital inflows and outflows, vis-a-vis the United States. Because if you start to see, the dollar continue to weaken and other currencies strengthen, relatively speaking, then there's less incentive for other countries to keep their capital reserves in America because their currency is now stronger. And so they're losing the paper value of those holdings. And so, we started to see that earlier this week with Taiwan. That's a bigger story that we'll unpack later. But I think the point I'm making now is that Bessent understands the interplay between the real economy, the equity market, and the bond market, and he's a serious player. And you send someone like that when you're serious about cutting a deal. The second thing that I'll just say very briefly, January, is that I think it shows you a little bit about who's winning the jockeying for influence inside the administration. Whether fairly or not, I think lines have been drawn between folks who are, you know, maybe not as pro-tariff as some other folks inside the administration. Like you have the real true believers, and then you have the folks who believe in limited trade action, but not necessarily across the board tariffs. And I would classify Besson as someone who more believes in limited trade action. So I think it gives us insight into which voices are winning out inside of the administration as well.
Let me just talk a little bit about how this dovetails with some other news that broke this morning. I read a headline from the New York Times first thing this morning, and I was like, oh, that was the expected impact. And then when I unpacked it, I thought that's exactly the opposite of what you would have thought the expected impact would have been. And so the headline from the New York Times this morning, actually, let me just go back to it specifically because I was pawing through a few other things. Chinese imports to US hit 20-year low as tariffs sink in. So my immediate reaction was, a month ago, we were at a 20-year high. That was kind of that was the leap that I made initially, right? So from a 20-year high in 1 month, we dropped to a 20-year low with China. That's a major rebalancing of trade. That means the impact of tariffs has been super significant. When you actually tease out the data, that's not true at all. In fact, we have been on a 7-year, pretty significant decline in the imports that we have from China, which means that the trade deficit as it's ballooned in the United States is not actually only China driven. Now, China still accounts for a very large percentage of our imports, but when I went to dig into this, I thought that was the first kind of interesting takeaway. It was that this 20-year low is basically part of a larger decline that simply got a little accelerated. But interestingly, there were other impacts that weren't there that I also expected. I also expected to see a real softening of that blow with the pull forward of tariffs in the first quarter. It was pretty much business as usual, actually. And so what they said was right. On Tuesday, they reported from the Commerce Department specifically, Chinese imports into the US fell to 102.7 billion in the first quarter of the year, just 11% of all US imports. And I want you to tie in, by the way, how the message from Treasury and the message from Commerce is embedded in that kind of executive communication that you were talking about earlier. But right, so they said just 11% of US imports. So it's huge. Tariff news is huge. 11% of US imports is huge. And the tariffs on those are very large. But 7 years ago, China had 22% share. And so you've already seen a kind of trade rebalance that's happened in the last 7 years that is, as we've talked about already, insulating the US economy from some of these tariff changes to make this news wild, but also still not as dramatically terrible as we may have expected. Also, I wanted to dig into that because I thought that what you would see was actually a reversal of that in Q1. Once the announcement came April 2nd, I expected that you would have seen this kind of massive pull forward specifically of Chinese goods. What was interesting to me is that actually the pull forward wasn't in Chinese goods, at least not significantly. In the macro sense, that a lot of the pull forward was in supply chain, so specific products, and for pharmaceutical companies. So pieces of the market that have gotten big attention from the news, like dolls, Mattel actually did revise their guidance down because of profits. Philips yesterday kept their sales targets the same because of demand for medical devices, but revised their cash and their profits down because of potential tariff impacts that haven't been seen in the markets yet. So you do see these news pieces coming through. They matter. Certainly, like a reduction of cash in the system matters. But then you also see this and you think, oh, like the players that are playing in spaces that are harder to understand. We don't hear about them as much. If we really want to be a market outsider, understanding how these private sector, public sector, and markets, work together, we have to really get down one level to understand it. So I thought that those were specifically interesting that you saw like this pharma stockpiling. You saw China already on a downward trajectory, and there's a lot that's happening there. Back to you on the commerce treasury interplay, because just one comment about that. By the way, Naman, I've noticed that when people come to us, right, we work with senior executives that are preparing board deliveries, and we also prepare with people that have a 3-member team that they want to have more gravitas with, but I notice that when somebody walks into the room, the mastery that they have of the data and of the message matters, but also their understanding of their audience. Can you just talk a little bit about who gets it, you think, inside the administration? Who gets the audience? What do they get about what matters to that audience?
Yeah. So again, I think when you look at like the team that's around the president, I think the person that gets the audience the most is Bessent. It's the Treasury Secretary, because he understands as Secretary of the Treasury that his job is to maintain investors' confidence in U.S. Treasuries, right? Like his job, like he has a complicated job, but if I could boil it down to like a first grade definition, it's to make sure that the U.S. can continue to sell debt, and it's to make sure that the U.S. can continue to fulfill its obligations. And so a part of being able to continue to issue debt is to ensure that people have confidence that you're going to be able to pay it back, right? And that they have confidence in your currency. And so when he communicates, he understands that, for him, his audience isn't necessarily you and I. His audience is, global investors. And he's,
Large capital deployers,
yeah,
absolutely.
exactly, right? Like his, sovereign wealth funds, right? For example. And so, he when he speaks, that's why markets respond, because he's speaking to them. He's not necessarily speaking to you and I. And I think one of the things that you see playing out, maybe at Commerce, is you see someone who should be interfacing and speaking to maybe your cabinet level stakeholders around the world, who's actually more speaking to the American people, right? And that is, I think that's where you've seen some of the disconnect between, how messaging coming out of Commerce is interpreted and kind of what the intended effect was, because the language that's being used is really tailored towards you and I, when we're not really the stakeholders for some of those negotiations that are playing out in the media. A couple of other things I'll just very quickly add, Jenny Rae. You mentioned kind of, Chinese imports have been, on a downward decline right over the last 7 years. I think that is proof that some of the tariff action that was taken in the first Trump administration worked. And I think it's to the credit of the Biden administration that they kept those actions in place. So I think one of the things that the US government across parties had identified is that China was devaluing its currency and it was flooding the world with exports. And so there was action that needed to be taken to address that. And I think we've made progress. So I think that's a credit to the first Trump administration. It's also a credit a little bit to the last Biden administration. And I think one of the goals that Commerce has in releasing some of that data is to say, look, we were right, right? And like, because it's worked in the past, it's going to continue to work. The second thing that I'll just say, and I think this is what's not captured in the data, is that one of the things that China is doing is uh, it's rerouting its exports through other countries. And so I think on paper, you'll see that some like that Chinese exports are dropping, and they are. But my guess is they're not dropping as much as that data says, because what's happening is they're routing products through Vietnam. They're routing products through Laos or Cambodia or wherever. And so on paper, it looks like those imports are coming from those nations when they originated in China. And I am not enough of a supply chain expert to know if you can track that all the way through. But from what I've seen, what I've read, what I've heard, and what I would do if I was China, like that's exactly what I would be doing. And so my guess is what's playing out in the real world is a little bit less drastic than what you actually see in the numbers.
Naman, before we go to the $1 bet that of course is essential today with the Fed meeting, the last thing that I just want to say is that I was in the room when we were working on a charbroil decision to outsource to China. And in early days, the decisions were pretty simple. It was like, how much does it cost to make a grill in the US in Georgia versus how much does it cost to make a grill in a Chinese factory? And can you make the same quality grill, right? There were like a few kind of other factors. Can you make the same quality grill? How much inventory do you have to hold if you move to China? And how does that affect your overall cash? And then also, is there a customer perception issue? Is this buy American thing really important? So we looked at qualitative and quantitative factors, and honestly, like it was no contest. China was just wiped US production off of the map. We actually won that business at Bain because our partner who was assigned to it had the courage to say what the leaders in the room did not want to hear. He delivered it with data, but he delivered a message that was compelling, that was different than other consulting firms were offering, which was like, we can keep your manufacturing onshore. What I saw happen as a part of that longer term decision was that the asterisks on the decision became critically important over the next decade. The asterisks included things like, but what if Chinese labor costs actually does increase over time? But what about IP with your manufacturing? Could there be the emergence of an entire competitive supplier who simply uses the technology that we're sending to China to come back? And then also this kind of supply chain complexity piece in terms of specifically how much pre-ordering you have to do. One of the big things that we found was that you would have to pre-order your grills in something like November or December in order to have them in time for peak summer season. Whereas if you were manufacturing them in Georgia, those decisions were made much closer to the time. And I just want to really emphasize how like you can run a model, you can know what all the inputs are, but if you don't only know what the inputs are today, but how the inputs could change, your decisions could be really different. So I just thought I would bring that story in from the past.
Yeah, I, I think that's a beautiful encapsulation of how, you really need to marry storytelling ability with business acumen to succeed in the 21st century. We live in an attention economy. Nobody has, the attention span to sit there and like listen to you, like read out a model and the outputs of a model. Like you have to be able to share the narrative behind the numbers. Otherwise, why are you in the room? I'll just take a look at the model myself. And so, like the extra value that you bring as an advisor in any circumstance, whether you're an external consultant or an internal player, right, is that narrative, is that perspective. And that's one of the things that we're trying to impart to all of the teams that we work with. It's what's setting them apart in the age of digitization and the age of AI. It's the ability to unpack the numbers and communicate a narrative that's going to motivate action.
Naman, I think we should talk a little bit about the Fed as we close today because the Fed message has been a little murky, honestly, on day one, and the markets really held steady because I think they're a little less certain about what's going to happen and maybe not pricing in what they think we'll expect. So yesterday, you said you think the Fed should cut rates. I said, look, I think they're focused on price increases that are coming down. I think that they should raise rates by a quarter of a basis point. But today we're going to bet on what we think they'll actually do. So $1, Naman, what is the Fed going to do? What are you
I
willing to put
think
your money on?
I the only thing I'm willing to put my money on is that they do nothing. that they take a wait and see approach. I think that's the track record that we've seen from the Powell Fed, is that they were slow to act when we saw rising inflation. I think they're going to be slow to act now here on the back end as well. I think it's going to be a wait and see approach.
I absolutely agree. So I guess we have $1 with no odds on it on the table. So this
We're
is
gonna have
no
to come
fun,
up with a
Naman.
better bet. I'll bet you $1 on some of the NBA playoff games tonight. How about that?
Naman,
Yeah.
I bet you've already bet $1 on some of those games. Look, I think it's pretty interesting, but I think the markets are kind of betting the same thing, right? Like there are some people who would say from an employment standpoint, you should drop, which is would be, by the way, politically on course with what they've done, and the only likely surprise of today would be a drop. It would just be a pull forward of when we're expecting the timing to happen, or actually more like a consistent approach from what they originally announced, but not in light of the new news that came out in April. I think that an increase would respond, but probably in a way that would really throw the trajectory off. So, I think holding steady makes sense. Let's see what happens tomorrow. We'll find out whether we were any good at identifying what we thought they would do. So it's fun to talk to you today. Thanks so much for jumping on. Markets are open, everybody. But don't forget that there's a lot of money to be made on the outside of the market. That's why we're here, market outsiders. So we hope you enjoyed listening today. If you've got questions about exec communication, training, the way that policy impacts the market and the economy, we're here for it. Please write us, shoot us a message, and bring your questions to a future episode. We'll see you same time here tomorrow.